Hey guys, welcome back to the channel. My name's Avery Lewis and you're watching Simply Finance. This is the continuation of part 1 of this series. Thanks for stopping by and please smash that like button. Any options or short-term trades that I've made due to FOMO or perceived opportunities typically lead me to make actually poor decisions. For example, the most classic case is that people will see the markets in a rally and then join in hoping for a continued rally. A rally is a period of time in which stock prices prove a positive trend in their prices. As hopping into the market as the rally is continuing, usually the gains that are missed will never come back, so you always need to stay in the present. Being in the present and continuing on disregarding what you missed will always prove more valuable than looking back on what you didn't make. This is because I've heard so many times, the stock market will continue on with or without your money. In case this isn't really making that much sense or it's just too much coming at you at once, I'll provide a quick example. I really wanted to open a call option on this one exercise distribution company during the illness. Because of this, I set a limit order to buy the position as it seemed to be gaining momentum quickly. And I'll go over calls and limit orders soon. Anyways, I woke up before the market the next day and I saw that the price had increased higher than the price I set as my limit price. Therefore, my human error and greed took over and I still decided to buy the option at the even higher limit price. However, right when I thought I made a great decision and I paid double the price that it was originally, the stock started to drop. I ended up selling the position at about half the price what I paid for it, or what my original investment would have been. The inability to let go of my decisions and what I could have had led me to lose almost $100 in that one morning. So going over this option that I bought, what is an option? Basically, I bet that the stock price of that certain company would hit a certain number, and in this case it was $6.50 per share. And if it didn't hit that price and I let it go until the expiration date, then I would have lost all the money that I paid for that. Basically, these contracts that come in sets of 100, here's how it works. You pay a premium, which is an upfront cost, in order to claim the stocks at a certain price in the future. Since one of these calls contains 100 contracts, I was ultimately buying the right to sell 100 shares at a higher price in the future if the stocks hit the strike price. The strike price is the price that I was hoping that the stock would hit and even rise above. For every $1 that it went above that price, I would have made $100 on my investment. However, since the stock was trading at such a low dollar amount, going up $1 would have been almost 20% gains, which was pretty much unheard of. This is why stocks like Amazon or Tesla that trade above $1,000 or even $2,000 per share are so much exponentially expensive than this stock that was trading below $10. The reason that I and many other new investors buy options in these smaller priced companies is because you're risking less, but you're also willing to take less in reward. This risk reward is actually a huge lesson that every stock market investor and enthusiast has learned and continues to learn. It also contributes to the market sentiment, or the feelings of investors. And this is basically the only place that feelings actually come in handy and aren't bad for you. This is because it's very healthy actually to assess your risk and what you're willing to risk in return for reward. Those with higher risk tolerance typically buy options, and those with lower risk tolerance typically buy bonds, which is buying a company or government's debt in order to receive interest in the future paid back by the entity. However, I'm not on the really conservative side or really aggressive side, but I'm somewhere here in the middle, and I'm a more moderate investor, investing in blue chip growth stocks. While I have dabbled in some dividend stocks, I do think that the growth stocks that I've invested in will provide me greater returns in the future. Growth stocks would be something like Amazon, who will likely increase their revenue or profits and expand their brand in the future, whereas dividend companies are companies that pay out a significant amount of their profits to their investors while investing less back into their business. There are other types of companies and many reasons that a company will decide to be a certain kind of company, but typically, technology firms will prefer the growth style, and banks and airlines will go the dividend route. This is mainly because the expanding market of technology, and we haven't really hit that stagnant level with that, whereas banks and airlines have mainly hit what their predictions are going to be for the future. Until some revolutionary bank thing comes out or some revolutionary airline new plane something comes out, there's really not much to grow in their companies. But both growth and dividend stocks do have their benefits, and investors consider active returns versus passive income, or somewhere in the middle. Active returns come from the profitability of a company, bolstering the value of each share in that company and returning those profits to investors in the form of increases in share value. The way that dividend stocks differ from these growth stocks is that the companies will return the money to investors as passive income, meaning the investor will receive the money directly from the company in the form of a check or through their brokerage in the form of dividend reinvestment. The benefits of the different companies is that growth companies have almost limitless upside. This is different than dividends because dividends are guaranteed income at historically lower return rates, but also experience moderate returns on their capital as well, kind of getting semi-best of both worlds. This is why I'm not terribly aggressive, but also not terribly conservative, because these growth stocks have potential to lose all my money with no dividend guaranteed, but also the reward is typically higher. Now, if you want to get into dividend stocks, the most common are the dividend aristocrats, for a very good reason. These stocks have seen their dividend payout rate increase over the past 25 years uninterrupted. This is great because this means that the dividend is very safe and will likely increase the gains more over the years as the share price also continues to grow. Although these stocks will still likely not outperform the better growth stocks, there is still value in dividend aristocrats because they have proven themselves, and some have even increased their dividend for over 50 years. Besides growth and dividend stocks, there's actually another type called value stocks. These stocks are what made Warren Buffett who he is. Basically, they're declared as undervalued and not necessarily in either of the extremes of the growth or the dividend stock. Value stock just refers to any stock that may have potential to buy as it is marked down and on discount. Just as we've seen with the illness, in March, almost every stock looked like a value stock. These stocks may contribute some dividends to their investors and they may be growing pretty fast, but the main reason they carry the title of a value stock is due to their underlying fundamentals such as dividends, sales, and earnings. Earnings are reported mainly by companies just to give investors insight into how valuable their stock actually is and how much profit they've made per share over the year or over the quarter. The total profit of the company in the quarter is divided by the number of outstanding shares of that company, and this returns the number that represents the company's profitability over the past 3 months. Now, earnings are a really big deal, and before the earnings of each company, once every 4 months, analysts will make their estimates to what they believe the company will actually report, and this is a really big deal. If the actual earnings per share beat the expectations of the analysts, a stock will typically see a pretty substantial increase in investor sentiment and therefore an increase in their stock price. And on the other hand, this typically holds true the exact opposite way. If the earnings per share don't meet the expectations of the analysts, then typically the stock's share price will go down. While these earnings typically contribute to the value of a stock, so does the dividend yield of that stock too. The dividend yield is mainly considered in dividend stocks, but can also be considered in any stock that provides it. A firm may decide to pay it out annually, quarterly, or monthly. However, most firms decide to pay it quarterly and spread out the payouts 4 times across the year. There's a term earnings season, which is typically a hit with the analysts and sparks a lot of volatility compared to the rest of the year. As companies are required to release their financials, the implied volatility, or the projections of the company's future forecast increases as there is a lot of hype surrounding the winners and losers of each sector. This implied volatility also functions in the pricing of the options contracts that we talked about earlier on. The premium of stocks with higher implied volatility will ultimately be higher just because it's more likely that they'll hit their strike price. This requires a larger commitment up front just in order to secure the better bet. Now, often these options are typically seen as the riskiest play you can take in the stock market because of the upfront cost and its implied volatility, which may be up or it may be down. They also might not change enough as much as necessary to break even, or it may change enough, but in the wrong direction, so you never really know. So guys, sorry for keeping you a little long, but I just wanted to explain the first basics of the stock market that I thought that you should know. Thanks for watching, and please smash that like button. I spent time writing this and editing, kind of, and filming, so please smash the like button and have a good day. Peace.